Have you entered into a joint development agreement (JDA) with a builder and are wondering when you'll be liable for capital gains tax? Wait. There's a crucial provision in the Income Tax Act that could significantly impact your tax obligations. Under the Indian Income Tax Act, the transfer of rights under a JDA is generally considered a transfer under Section 247, making it subject to capital gains tax. Traditionally, this meant that tax liability arose at the time of signing the agreement, even if the landowner hadn't received any consideration yet. However, to address the hardships faced by landowners, the Finance Act 2017 introduced Section 45, 5A. This provision specifically applies to individuals and Hindu undivided families, HUFs, entering into a registered JDA for the development of real estate projects. Deferred taxation. Capital gains tax liability arises in the year when the competent authority issues a completion certificate for the whole or part of the project, not at the time of signing the JDA. Full value of consideration. The stamp duty value of the landowner's share in the project on the date of the completion certificate, plus any monetary consideration received, is considered for capital gains computation. Remember, if the landowner transfers their share in the project before the issuance of the completion certificate, Section 45, 5A doesn't apply, and tax is levied in the year of such transfer. Judicial interpretations must as well be kept in mind. In CIT vs. Balbir Singh Maini, 2001-7398 ITR 531, the Supreme Court held that an unregistered JDA doesn't constitute a valid transfer under Section 247V, as registration is essential under Section 53A of the Transfer of Property Act. Thus, capital gains tax isn't applicable at the time of signing an unregistered JDA. Viewers should note that Section 53, 5A applies only when the JDA is registered. Another ruling worth noting comes from the ITAT Chennai in Tamil Nadu Brick Industries vs. ITO, in which tribunal ruled that executing a general power of attorney (GPA), granting all rights to the developer amounts to a transfer under Section 247 OV, triggering capital gains tax in the year of execution. Understanding the nuances of capital gains taxation under JDAs is crucial for effective tax planning. Right finger like, share and subscribe to taxworry.com for more insights into complex tax matters.